The information in this podcast is educational and general in nature and does not take into consideration the listener's personal circumstances. Therefore, it is not intended to be a substitute for specific individualized financial, legal, or tax advice. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a final decision.
All right, we're back with another one today. We have a fantastic podcast for you guys. Appreciate you joining and checking out how to learn to retire on your XRP. Today, we have with us Tom Teal, who is our head of financial planning and architecture for many of our clients over there at Digital Wealth Partners. Tom, thank you for joining us.
Yeah, happy to be here. Always excited to talk about financial planning.
Absolutely. So for those that may not know who you are, obviously, you work at Digital Wealth Partners and we've had a long-standing relationship. Can you give people, some of your background that allows you to, work with clients in the capacity that you do to help them structure things for their retirement and, their financial goals?
Sure. Yeah. So oddly enough, I actually graduated from college with an electrical engineering degree. So most of my career was kind of spent on that side of things, which was great. I got to, do a lot of traveling, work on a lot of cool projects around the world. But, I think we all kind of get to like a stage in our life where we start to sort of question our overall impact on, friends, family, community. It's great working for a big company for some period of time, but I think you can kind of feel lost in the shuffle. So yeah, I came to that that phase of life, I guess, and sort of made a 90-degree turn. And being a financial advisor was, number one, a good fit for like the analytical engineering part of my brain because of numbers and things like that. But also, definitely gives me the opportunity to positively impact people's lives. And again, especially those people close to me. So it was a great fit. I think the other thing that has kind of helped me is prior to becoming a financial advisor, my wife and I had financial advisors. So we worked with advisors from various different companies, custodians, RIAs. And, I think anytime you get experience like that, you kind of figure out what you like and what you don't like. So I've been able to kind of take that experience, plug it into how I think, financial planning should be done and what seems to resonate with clients. And then again, that's kind of brought me to where I am today. And I've been through, like most financial advisors, you kind of usually start off in a big institution. So I started off with Northwestern Mutual. That's kind of a pretty common one. And that kind of gave me an insight into, the insurance side of things. And then from there, went to work for a few different RIAs. And as you've heard, and most of our clients are familiar with, their traditional advisors aren't really allowed to or equipped to talk about digital assets. And that always bothered me because as a fiduciary, we're here to provide the best financial advice we can. And if clients are asking us directly about an asset class and we're telling them we can't talk to them about it, it just seemed weird to me. So yeah, that's what kind of was the catalyst for me to decide to get into the digital asset side of things. And here we are today.
Well, and you and your son, was he the one that ended up getting you into, like, obviously we all have our own investments and you can't get, anybody's specific financial advice on this call. But like, what's your background in crypto and how did you, decide, we have a mutual friend. So just for background, reached out to Anchorage when we had originally started this and we wanted the best of the best. And we talked to them. We said, hey, do you know any financial advisors that have some experience in crypto, but also on the TradFi side? And they were like, got your guy. And
yeah,
so you came highly recommended. But yeah, I think it's good for people to have context on the crypto side. I mean, you've done staking, airdrop farming, like you were doing all the more stuff personally.
Yeah, I've been into a lot of the dark recesses of the crypto world. So I've experienced kind of a lot of those different things. The first, we all have like those moments where we look back and we're like, oh man, I wish I would have invested at that point in time when somebody like mentioned Bitcoin 10 years ago, or, like you have a cousin who was looking into doing Bitcoin mining and you're like, what is that? And, you kind of gloss over those things. So we all have like those kind of stories to tell. But my son and I got into crypto originally during the beginning of the NFT craze, and it was on Solana actually. So at the time, Solana was just very accessible, easy to like get in there and set up a wallet and mint NFTs. Ethereum was more complex, more expensive. It wasn't so much like you had to know generally what you were doing with NFTs on Ethereum side because it would cost you some amount of money to be. Right. Solana was like, it was for everyone. Yeah, super easy. So that was like the beginning. And, what really, I think what we liked about it initially was the communities. So, especially back then, during the COVID times and coming out of COVID, like everything was going well in crypto. So everybody was very happy, like communities were very tight. And so, you just had a lot of fun. So that was like the initial, like I said, entrance into it. But then from there, yes, it branched out into, all right, let's understand kind of all these different blockchains. What do they all bring to the party? What niche or narrative are they,
solving?
Yeah. And then, beyond that, from a financial perspective, again, what solutions are they bringing to the table? So that's where, getting involved on the just figuring out how the DeFi side of things worked, the decentralized exchanges, all those different things. Yeah. Airdrop farming was one of those things. But like everyone, I've that's been in crypto for any period of time, I've learned all my lessons painfully. We all make bad decisions or things happen. There's broke bulls and all that kind of stuff. So yes, I do have all that kind of background experience. So a lot of clients that we work with have, again, if you're in crypto long enough, you're going to have a bad situation at some point. So yeah, it's very easy to empathize with clients who have been in bad situations, and are worried. They just have, and it's healthy to be skeptical when you're in crypto. So yeah, like I said, I can always empathize with clients that kind of come at things from that perspective.
No, I think that's a really good perspective that you can share with people because, most financial advisors, again, have stayed away from this personally and in their professional career. And I think that's really what's helped our team grow is everybody is open to this asset class. They have their own war stories, and they have the empathy and understanding to be able to help guide clients to mitigate those risks and then, keep them from having the same situations playing out. Right. So on that, I just want to roll it into, the retirement here. So I think before we do that, like, what is your definition of retirement?
Yeah, that's a great question. And this comes up all the time when you talk to clients because traditionally, age 65, retirement, like that was the thing. It's become much less of the thing now. Yep. Retirement kind of looks different for everyone. Again, it used to be because that's when Medicare kicks in. You don't have to worry about paying for healthcare. That's kind of like everybody strived to get to 65 so they didn't have to worry about paying the cost of healthcare. Now, yeah, retirement looks a little bit different to everyone. I think if I try to paint it with a broad brush, retirement is kind of when you start to rely more on your assets for cash flow, less on income. Now, again, a lot of clients will still continue to work in some capacity, even though they're quote unquote retired. Like we all still need, purpose, things like that. Yep. But yes, I think that's, like I said, from a very high level, when we start to look to have to generate cash flow to support lifestyle needs off of assets, to me, that's kind of retirement.
And that makes sense. And like, when I talk about wealth creation and wealth preservation, you have to have some fairly substantial assets in order to be able to put them to work to generate enough cash flow for most people to retire comfortably.
Right.
There's a lot of people that get to 65 or older that didn't position themselves well. They didn't buy assets. They didn't understand the difference between an asset and liability to even figure that out. And, a lot of what we do on the channel and a lot of what I spend most of my time on is helping to educate people on what this stuff is, what assets are, basic fundamentals behind investing. So let's say somebody has positioned themselves well. They are, most of our clients that we deal with on a regular basis are 35 to 80 years old, pretty wide variety. Like you mentioned, very different age groups for retiring and needs and timelines, right? Risk tolerance probably also differs wildly.
Yeah, for sure.
So when you're looking at that, Do you have a paradigm or maybe a compass that people could follow that would help them figure out how to diversify their assets or make allocations to most benefit them, or questions that you normally ask clients?
Yes, definitely. So, your point about risk tolerance is a good one, and it's kind of funny. When I was on the traditional asset side, obviously that was always you always talked about risk tolerance, whether they're from risk averse or very much risk on. And of course, within couples and marriages, people were in different places. You can kind of get a sense just from talking to somebody for a few minutes, kind of like what their risk tolerance was. When I came over to the digital asset side, and obviously our clients all hold some amount of digital assets, and you ask them, and we have clients who are 100% of their net worth is in digital assets, and you ask them, do you feel like you're conservative or aggressive? And they will say, I feel like I'm a conservative investor. So back to the paradigm, it's very much a perspective thing on the risk side. Because if you have conviction in an asset, to you, that doesn't seem risky, but to a financial planner, when we talk about, again, having to generate cash flow and like our retirement plans, depending on how old you are, and majority of the people we build plans for, like you said, 40s, 50s, 60s, we're planning for another 50 plus years potentially, right? Where you have to be able to live off of those assets. And while I would love to say that I can see the future, we have to be prepared for all types of eventualities. So yeah, when a client comes to us and, really the first question, even aside from the risk tolerance, goes back to like goals. Like the bones of any financial plan revolve around the client's goals and what they want to accomplish. Like, what does retirement look like to them? What type of cash flow do they think they need? So when we have those pieces, those help define the cash flow needs over time. And some of those goals are like one-time lump sum cash outflows. Maybe it's a vacation home. Maybe it's take the family on a cruise that's going to cost them 20 grand or whatever those things might be. When we can put those into a plan, we can then plan for those cash flows. And then that helps, again, dictate to us what does a good allocation look like to be able to meet those goals over time. Because there's going to be short-term goals, like inside 1 year. There's going to be called medium-term goals, 5 years or less, something like that. And then there's going to be longer-term goals, which is 5-10 years out.
Yeah.
And we want to make sure we're positioned to be able to provide cash flow for all of those timeframes. And again, that will then sort of circle back to, okay, what portfolio allocation, what asset classes should we hold? Where is the cash flow coming from? And of course, clients come to us with an existing portfolio, whether it is all digital assets, whether it's a combination of traditional assets and digital assets. Maybe they have a large real estate portfolio. So in some cases, we can make changes in the short term, especially in retirement accounts and things like that. In some cases, we can't, or it's going to take an extended period of time, or clients may not want to make changes. We can provide guidance, but it's at the end of the day, it's the client's decision. We are fiduciaries, so we'll provide our input. But if it says, no, I'm committed to this and I want to make this work, then we work within those guardrails. So yeah, there's a lot of questions that go into, again, the asset allocation piece. It's kind of, that's a byproduct of, back to your point, understanding what is their risk tolerance, what are their goals, what is retirement look like for them. And then when we build out the plan, and that helps inform the asset allocation side.
Yeah, I think that makes a lot of sense. You want a deep understanding of all those goals and timeframes and what it's going to take to accomplish those with their cash flow needs. And then, you're projecting returns based on, assumptions that you're making either from historical evidence or for, future events that might play out. Obviously I do that for myself on a regular basis and share that with other people. And I think our advisors, I would say you guys are probably a bit, again, I talk about like, I'm 34 years old.
Right.
I think maybe people have a misconception that all of our advisors think the same way I do and kind of push the same narrative. And I would say that that's not the case. I think you guys are much more conservative in most circumstances, and probably have far lower expectations of returns in the short term for clients, and help them navigate that in case that is the eventual outcome. Right.
Yeah, 100%. And In full disclosure, I know I look 35, but I am 50. My wife is 51, and we have a dynamic that we come across again with a lot of clients. I'm very much into digital assets. My wife very much not into digital assets. So her portfolio looks very different from mine. I manage both of them, but I'm not going to put her into digital assets against her will because we know how that would go.
Oh yeah.
So yeah, that like I said, from an advisor perspective, when we run a financial plan, we run what's called a Monte Carlo simulation. So basically, the plan will run 1,000 different simulations based on different market returns for different asset classes. And what we try to plan for is to avoid the worst case scenarios. We don't really plan for the best case. We make sure we're okay on the worst case side. So, we'll run those 1,000 simulations, and there may be, some percentage of them that you go to zero before, you're 95 or whatever our planning date is. So we have to, by nature, be, more conservative. If those, if the market turns out to run and, does huge numbers and you end up with, tens of millions, right? That's a whole different, that's a different planning initiative because we're now talking about estate taxes and, your goals may change because maybe you want to do more charitable things, whatever that might be. And that's perfectly fine. We can always shift gears. To your point about, everything changing all the time. I try to make the analogy like your financial plan. It's like we're standing on the deck of a ship in a storm, trying to throw a dart at a dartboard. There's so many different variables. Things are constantly changing. When we build your plan, 5 days later, if we rerun it again, it's going to look different because the asset values have changed. So what we try to do is we're trying to minimize as many of the variables as possible. Okay, which direction is the wind blowing? Okay, let's kind of account for that. Is the ship going up a wave or down a wave? Let's kind of account for that. So we try to minimize the variability there, but again, we can't see the future. So we have to try to plan for or avoid those scenarios where the plan doesn't look good. And a big piece of that beyond just the planning, the goals, the asset allocations, flexibility. We talk to clients about this all the time too. To be successful in retirement, you really want to try to go in with as much spending flexibility as you can, because in those years where the markets are down, it may behoove you to spend less in those years because we don't want to sell from depreciated assets. Of course, we, try to have cash available, but again, we talk about try not to go into retirement with a bunch of fixed expenses because fixed expenses are fixed expenses. Whether you have the money to pay them or not, they're going to be there. So the more you can minimize that, the less stressful, number one, retirement will be. And number two, probably the more successful you'll be, because if we do have a consecutive number of down years, you can adjust your spending.
Yeah. Well, so on that, like, what are some of the strategies that you guys employ? I mean, they could sell some of their assets over time. You got to deal with the tax implications if you do that. We have ways that people can use the assets directly to be able to generate returns on those that, create some cash flow for them. We've seen other people, we have relationships to be able to provide loans with third parties. It's not like we lend the money to the people. We have trusted other parties that are large banks or fintechs or institutions that'll provide that liquidity. And then we've got some higher end products where people are able to generate some premium off of selling some options and stuff for people. So would you break, maybe you never go broke taking profit. That's what I tell people all the time. Yeah. But how do you navigate what's best for each person in that situation? Like you said, you got those goals that you lay out, but once you have those in place, like, I guess just talk maybe through that.
Sure. So yeah, again, just from a very high level, we kind of approach portfolio allocations from a barbell strategy side of things. So what we mean by that is we kind of, you'll hear the term bucket strategy also. So we try to have cash available for about, and again, depends on the risk tolerance of the client, somewhere around 2 to 3 years worth of cash or cash-like instruments. Now you can be earning money market returns or, basically conservative investments that are earning some amount of return. So that when we do have those down years, we can pull from that bucket to provide lifestyle spending. We don't have to sell from assets that might be down. So that's one piece. But on the digital asset side, and there's similarities to traditional assets, but as you know, it's not as built out as what you can access on the traditional asset side. We'll get there someday. And so we're, at Digital Wealth Partners, we're trying to put pieces in place to provide clients with similar solutions. But the first one, like you said, there's kind of like 4 ways for clients to generate cash flow off digital assets. And again, there's similarities to the traditional side. So number 1 is selling. On the traditional asset side, people don't really get emotionally tied to their assets as much. Like when it's time to sell or generate cash flow, they're generally fine with it. On the digital asset side, obviously people are on different sides of the fence when it comes to selling. There's the I'm never going to sell crowd, which I completely understand. And then there's people that aren't necessarily emotionally tied to the asset and are fine selling it when the time comes. So the advantage with selling digital assets, number 1 is, and I think you and I have talked about this before too, like as your net worth grows, your perspective on money changes. And probably, your ties to the assets that you hold will also change. I do, and advisors of Digital Wealth Partners to, counsel clients that like, as your assets go up, you're most likely going to want to diversify, especially when you're relying on them for cash flow. You're going to want a more steady cash flow, or as at least some amount to be as steady as possible. Because one thing you're not going to want to do is be in retirement and then suddenly have to, like I said, cut your spending because your cash flow has been cut in half because your investment's gone down or something like that. So one way, obviously, to generate cash, again, back to selling is selling the assets. Now, capital gains, selling, inside an after-tax account, you have capital gains, different ways to mitigate capital gains. There's some flexibility there. If you're, again, retired before you're taking Social Security, you theoretically can have a lower AGI, so your capital gains rate can be lower potentially. So that's an advantage. There are ways to mitigate capital gains. There's qualified opportunity zone funds. There's obviously charitable giving, donor advised funds, and things like that. So when we know what the cash flow needs are going to be, we can do some preparation ahead of time to try to minimize capital gains taxes on that piece. So selling certainly is an option. Now, back to like, when do we counsel clients to sell versus not? Some of it, again, comes down to client preference. Like, clients will have a certain target price in their head that they're okay selling at. And we as advisors try to have that conversation, because if you can put it out there into the world, or have the client put it out there into the world, it becomes a little more firm, because we've all been through the crypto experience of riding something up and then riding it back down. Yeah. So we do try to, again, have those conversations. And then back to the barbell strategy, depending on what our cash flow bucket or our cash bucket looks like. If we've depleted some of the cash bucket and then the market comes back up, then we may look to sell from those appreciated assets now to refill the cash side. So those kind of, again, dialogue, those kind of discussions happen on a regular basis throughout the year and over the years as their net worth ebbs and flows depending on what market conditions are. So that's the selling side of things. And again, back to the diversification on the cash flow piece. A lot of clients, I think, will want to diversify into other cash flowing assets. Not that they're going to want to totally get out of digital assets. I wouldn't want to totally get out of digital assets. I'm sure you would not get totally out of digital assets. But not even minimizing, but adding exposure in other areas probably will make sense for many people. The second option is the investment products. So you mentioned the investment products. So at Digital Wealth Partners, we are working on products to provide returns for digital assets. You always talk about one thing digital assets are not good for is cash flow. Again, back to, there's plenty of products on the traditional asset side to provide cash flow against traditional stocks, bonds, there's all that kind of stuff, not so much on the digital asset side. So we're trying to build those opportunities for clients. So those are investment products where you can invest your digital asset and then potentially earn a return on that. When we look at those products, we always try to, account for what is the true after tax and after fees return look like. It's one thing to look at net numbers, and gross numbers, that's fine. But we do like to look at what do we project your net after tax cash flow to be. And so again, we have different products depending on client risk tolerances and client goals and what their cash flow needs are. So some people that are in retirement that are heavily dependent on their digital assets to provide cash flow may need one solution. For the younger crowd that's in their 30s and 40s. Maybe they're just looking to supplement some cash flow. Maybe they're just looking to help with AUM fees. That could be another product allocation for them. Or if they're just long-term holders and just looking to grow the amount of digital assets they hold, we have options for that too. So it all ties heavily back to what is that individual client's goal? Again, informed by what their cash flow needs are, if they have any. And then again, trying to figure out with their advisor what product allocation makes the most sense and doesn't match their risk tolerance. So that's the investment product side. The loans, obviously, you alluded to those earlier. Again, right now, loans against digital assets tend to be more in favor of the lender versus the borrower. We hope that changes in the short term. I know our clients hope it changes in the short term. And I think, as we see more financialization of digital assets, we will see those terms certainly get weaker. So those are just another tool. You can take out collateral or take collateral and take out cash against it. The loan terms will differ depending on the lender that you work with. But again, it's a tool for liquidity. And again, depending on what cash flow you need and what your timeframes are, those loans can certainly fit into a financial plan. So it's another tool in the tool belt of advisors when they're talking to clients about generating liquidity. And then, the third one you touched on. So the premium, we've kind of seen lately with the larger Bitcoin holders, starting to sell Bitcoin. They're also looking to generate cash flow. Bitcoin doesn't cash flow natively either. Right. So you can sit on a huge stack of Bitcoin, but you still need cash to live your life. So, one of the ways I think as your digital asset value grows, writing covered calls or generating premium against that asset can be another way to add cash flow. Now that's, I think another level in terms of net worth and the value of the digital assets you have. But it's, again, another tool where you can potentially generate cash flow by sitting on the asset. Now, at some point you could get called on the options and have to sell, but again, that kind of factors into the plan as well.
Yeah. Well, and I think a lot of people will probably use maybe multiple of those strategies, right? It's
absolutely
all be all this or that. It's more what makes the most sense for my financial goals and the outcome that I want, and which one of these, do I have the least amount of tax implications? How do I mitigate those? Maybe I, use a portion of my assets to generate returns, which covers the interest on the loans that I'm able to take tax-free. Maybe at some point we'll have products where you can do both, where it's kind of like a rental property where you draw a HELOC against it, but you've got a renter in there that's paying down the rent for you. And you go take that money and go do whatever you want, either live your lifestyle, make another investment, create other cash flow opportunities. That's what I'm excited about. As the assets continue to appreciate and this asset class is adopted, I think we're going to have a lot of opportunities for people to use tax-free strategies to be able to diversify their portfolio, like you mentioned, and also generate, and supplement cash flow for their lifestyle.
Yeah. Yeah. On the taxes versus tax-free side, we get into a lot of discussions with clients around obviously IRAs, Roth IRAs. So, qualified structures like that. And that, that's just another kind of piece of the puzzle. Like inside what structure do your assets sit? Is it an after-tax account? Is it a qualified account? Is it an IRA where you're going to pay income tax on distributions? Is it a Roth where, theoretically you're not paying any taxes on distributions? Roths can be a great vehicle for passing on assets to the next generation. So, that kind of comes into play. So we have to look at all those different pieces and figure out where is it most tax efficient to draw down from to provide, again, that cash flow. And to your point, we see all the opportunities out there in terms of the products that clients would like to have around digital assets that are, again, match up versus what they're used to on the traditional asset side. And we are certainly working towards bringing those things to market, but it just takes, as you know, takes time. And we have to bring a lot of different players together and herd a lot of different cats in a evolving market to get these things established, but we're definitely working on it.
Yeah. I mean, we did the DR against XRP, which is a depository receipt. That was, a partnership that we had earlier last year and got that to market. We haven't seen a huge amount of adoption for that yet. But I think as, the asset class matures again, there'll be larger amounts of margin that people could draw against that if they wanted to reflect that value out of Fidelity or Schwab or one of those other partners or providers. And then we'll continue to build out, our focus in the short term here is mainly around products for XRP. And then once we have those, we'll continue to build stuff for Bitcoin and a lot of the other digital assets that our clients hold. Would you say that most people have a diversification in crypto that are our clients, or you see people primarily siloed in one asset?
No, I would say probably 80 to 90%. So a very high percentage are diversified into multiple different assets. Rare that we have somebody just holding one asset. I would say, and if that is the case, it generally would tend to be like we see some Bitcoin holders that just, they've been in Bitcoin for a long time and they just tend to hold
The blue chip, it's safe. I'll
Yeah.
hold that one. I know, kind of like, if you don't have time to pay attention to something a whole lot, do all the research, you just want something easy, which is what I think a lot of people want to do, especially if they don't have an advisor that can help them navigate stuff. They're just like, okay, this seems like the sure play. I'm just going to continue to dollar cost average and, work my way in there.
Yep. Yeah. And so, yeah, most clients, like I said, come to us with a portfolio. Now, I will say if they come to us with a portfolio of like 20 different tokens, we'll probably talk to them about it might make sense to kind of pare that down. You can't really because there's so many projects, and back to your point about it takes some action on their part to just be kind of up to speed on what's going on. Again, going back to the whole conviction thing, if they don't really understand what they're holding and why they're holding it, and there's a downturn, bad things can potentially happen. That's when people look to sell at the bottom, kind of thing. So when they do come to us with a portfolio like that, I know advisors will have a conversation about, we probably should pare this down, and go through which tokens would make sense to peel off. And if they're holding like $1,500 worth of a token in a, couple $100,000 portfolio, something like that, unless they're really attached to it, like those kind of things, they tend to be like, yeah, I just have been holding this thing. I don't really care whether I hold it anymore. And they kind of minimize. But that's another piece. Yeah. Like I said, and back to your question, most clients come with a diversified portfolio of some sort. And we do have clients even that come to us that have not been in crypto. They want to get into crypto. And for them, starting off in some amount of a diversified portfolio is kind of, again, what they're used to and what they look to us to help provide guidance on which tokens should I hold, why should I hold them, that kind of thing.
Yeah, which I think you guys do a fantastic job of educating clients. So, we have a bunch of products at Digital Wealth Partners, and many that we're going to bring to market here in 2026. I think people have a lot of questions around those. Can you speak to some of the things that exist today?
Sure. So from a high level, we have two fund structures. We have the income fund and growth fund. These are, again, require clients to be accredited investors. So $1 million net worth minus the value of their primary home. And there's also some income thresholds that they can get over $300,000 if they file joint tax return. So the goals of these funds are sort of, as the name implies, the income fund. The goal is to provide income to clients, so cash flow to clients in their account. The goal of the growth fund is to grow the amount of digital asset they hold, in this case, XRP. Now, when clients come in, one of the first questions they ask if they are accredited and interested in being in the funds is, what allocation should I have? Should I have some of both? Should I just be in one? Should I just be in the other? And again, it comes down to what are their specific needs and what are their specific goals. If they are, again, younger, they're in digital assets for the next 10 plus years, they're just looking to grow the amount they have, and the growth fund can be a good solution for them. If they are retired and a large percentage of their assets are in digital assets, then the income fund can be a good solution because it is, again, providing cash flow to them so they can help fund their lifestyle needs. And then some clients, obviously, it will make sense to be, some mix of that. They may not be retired, but they want some cash flow maybe to offset AUM fees. Or again, maybe they just have a large chunk in, you've alluded to, what's the term you use? You're like digital asset rich, but cash poor.
Yeah.
Yeah. So we do have clients like that at, again, all age spectrums. So they just may need some cash again to help offset AUM fees or some lifestyle things that they want to accomplish. And so we'll talk through which of those makes the most sense depending on their situation. And then, like I said, that kind of gets plugged into their plan, and we sort of look at that outcome. And again, back to the planning side, we're looking at, we're touching base with clients on a quarterly basis just to check in, and then reevaluating their plan on an annual basis. So as things change, allocations may change. We may shift from one fund to the other, or if they're in neither fund, then they may decide to get into the fund or funds. So again, very dependent kind of on what the client needs are at the time.
Yeah. And with the other products that we're going to be rolling out this year, they'll be a kind of across the risk spectrum. I think these sit, they're definitely not, the lowest risk that you could possibly be, but I don't think they're like super risky either. And so, when I talk about them, I say this is just my perception. If it was on a risk scale of 0 to 10, 0 being no risk, 10 being all the risk in the world, somewhere like a 1.8, somewhere in there. Mitigated counterparty risk. We mitigated risk for volatility. That was proven on 1010 when we saw the huge market pull down and no XRP lost or called away. And the strategies that I think we have today are pretty strong, but we'll continue to add to those. And then that'll allow people to, kind of diversify across those given strategies to meet their different goals. And to your point, that should change over time as those goals change.
Yeah. Yeah. I mean, again, the funds are for accredited investors. We have a lot of investors who are not accredited. So we're, working on a solution for those. But back to your point, we're trying to provide products right across the risk spectrum. The funds, as with any investment, there's always some amount of risk. And as in digital assets, obviously, we never say guaranteed on any level, but we're trying to provide a spectrum because we have a spectrum of clients with a spectrum of needs. And as an advisor, our job is to be very upfront and transparent with clients about what to expect when they get into these products. The funds themselves are kind of, they operate a bit unlike what most clients are used to. They're not like a traditional ETF where you can check the S&P 500 price on a daily basis. And so, a lot of clients aren't used to that. So we spend a lot of time making sure clients understand how they operate, what to expect. And again, make sure that it fits with their goals and their risk tolerance. And then, for some clients, it's not a fit. But to your point earlier, we're trying to bring on more products that can give, anybody, regardless of their risk tolerance and their situation, everybody should hopefully at some point have access to products that make sense for them.
Yeah, I expect those, not too far in the distant future. I think there's a lot of applications specifically for XRP where other people need these too. Like everyone wants, you've got the treasury company or the DAT that's going to go live sometime in Q1. In addition to that, you've got other people that are holding XRP in their treasury for their corporation, enterprises and institutions both. Now that banks can hold XRP to pay fees on the network to be able to send transactions, they're probably not just going to let that asset sit there and not do anything with it. It's the same as, holding money in an account and not putting it to work. Banks are here to make money. And so if they're going to hold an asset, Ripple made the acquisition of G Treasury. So they're doing liquidity management and treasury management. So I think there's going to be a lot of people clamoring for similar products to what we're doing. I just don't know that there's going to be a lot of access for high net worth individuals or quote unquote retail clients to these products. I think it's going to be very institutional facing, and I'm excited that we're going to be able to kind of be on the forefront and champion that for the average person that has a significant holding in crypto moving forward.
Yeah.
So that's what I'm excited about in 2026. What are you most excited about in 2026?
Yeah. The funny thing, I think I gave a webinar on like setting goals and values for financial planning a couple months ago. And in there, I sort of had my list of goals, which if you go back, I think you could probably see them in the screen. But one of my big goals going back to becoming a financial advisor is I do have like a number in mind of like number of people I'd like to help just from a financial perspective, like provide good financial advice. And I have criteria around what counts as a check mark versus not. It's not just I have like a simple 30-minute conversation kind of thing. And I think for 2026, I think Digital Wealth Partners is going to be able to help a lot of people kind of navigate the digital asset space, especially, in times like this. It's one thing when prices are going up. It's another thing when prices are going down or staying flat, even though news is good. You've seen it. I've seen it. When you talk to clients, they're feeling it. It's just, it's a tough time right now to be a digital asset holder. And we want to make sure that clients aren't making bad financial decisions as a result of that, because it is very difficult to navigate, an environment where your assets are depreciating in value, or again, not moving sideways and not going up. And you make snap decisions or irrational decisions because we're all human beings. There's that saying that the feeling of loss is twice as bad as the feeling of gain. So, if you lose 10,000, it makes it feel like you're losing 20,000 kind of thing. So anyway, I think 2026 will be a big year for us helping clients to navigate the digital asset space, put the right pieces in place for their financial futures, feel confident about, being in digital assets and the people that they're dealing with from a digital asset perspective. So that's what I'm looking forward to for 2026. I've been in crypto long enough that I try to really just tune out price. I'm in it, I'm a 5 to 10 year window kind of person. I like what I'm doing. I'm not looking to retire tomorrow anyway. I just try to be patient. And I think we tried, I know advisors are impressing upon clients that just, you have to be patient. That's what, again, prevents us from making mistakes along the way. You use the analogy, and I've kind of adopted it too. We're here to help clients kind of get to the top of the mountain. It's going to be, it's a somewhat perilous journey with conditions changing all the time. So our job is to, again, help make sure we get as many people to the top as we can. And that the top is going to looks different for everyone. Everybody has different goals. Being rich is not the same as being wealthy, and wealth looks different to everybody. So, I think, like I said, 2026 for that I think it'll be just kind of a pivotal year, because we're seeing all this positive things happening in the digital asset environment. Lots of positive news, lots of tailwinds, great things happening. If you've been in crypto for any period of time, these kind of news releases are what you've been waiting for years and years, and they're finally here. And it feels like price isn't doing what it should be doing. So I know a lot of people probably are, I don't know about losing hope, but they're definitely down in the dumps about it. So I think this will be a pivotal year for Digital Wealth Partners, for the digital asset space, for the advisors, and certainly for our clients. That's kind of like the big one for me, I think, for 2026.
I love that. Yeah.
And off of that, the amount of people I'm helping from a financial perspective, for sure.
There's you talked about the emotions, right? When you're down, you're down. When you're up. I think an advisor, if they're a good advisor, helps you get back to baseline.
Mm-hmm.
You can make good, coherent decisions about thinking logically through something instead of getting caught up either direction. And because to your point earlier, we've all ridden it up and then ridden it back down.
We all have those stories, for sure.
And some people scale out on the way up, and some people scale out on the way down, and some people dollar cost average in on the way up and dollar cost average in on the way down. But if you believe in it over the long term, like you said, and you have conviction on something, then you're going to be resolute in that decision and continue to dollar cost average, and we'll continue to build out cool products that benefit everybody to be able to hold it over the long term, or have access to all the other cool stuff that you might be looking at, whether that's real estate or private equity or private credit, or the premiums, calls and puts like you were talking about. It's all ever evolving. So if people, go ahead.
No, I was going to say, we'll, at the end of the day, we'll we do our best to get you there. And then helping you define what there looks like is the other important piece. And, not to belabor the point of like the sentiment and, how people are feeling about digital assets. But again, this is it's a short-term thing. The more people can focus on like, what is it that truly, not to get too woo-woo, but what is it that truly makes you happy in life? A lot of those things don't cost necessarily a lot of money. And so, focus on those things while you're waiting for the asset appreciation side. That can make things a lot more tolerable, helps build and, let you be more patient. I've learned, again, probably just like you, to be successful in digital assets, about the only thing I can be good at is being patient. All those other things like scaling in and out, trading, those kind of things, definitely not my forte. I have behavioral psychology issues like everybody else. And so, yeah, being patient is kind of the best way that I found to continue to make money in the digital asset space. And the way you kind of be patient is focus on the plan, focus on what makes you happy today, try to like feed those things. And then, we'll get there eventually.
Yeah.
Yes.
Who you are, more abundance comes to you,
Yeah.
Well, if people want to reach out and they did want to, get a consult with Digital Wealth Partners, or, get institutional custody or access to the products, or they just want to learn more about what's going on, what's the best way for them to do that?
Yeah, well, definitely check out our website. There's a contact us form on there. That's a great place to start. Fill that out. It's got a couple of fields just asking you for some more information. That'll be a good entrance into the firm, and then somebody will reach out to you.
digitalwealthpartners.net. Very good. Well, thanks again for your time, Tom. Really excited for 2026 and all the people that you guys over there at Digital Wealth Partners can be able to help. And again, for all the products that are coming to market. With that, we'll let you guys go. Thank you so much for taking time out to come watch the channel. If you haven't yet, please like, subscribe, and we'll see you on the next one.